Hey Bowtie Nation, Joseph Hogue here with a $3 trillion time bomb under the global economy. One that started ticking when BlackRock recently told investors, you can't have all your money back. It's a part of the market that has quietly become the backbone of business lending, and when that money stops flowing, it won't just mean lost profits, but also lost payroll. And that means layoffs on a scale we haven't seen since 2008. I'll explain why, what is about to happen, and how to prepare your finances, along with the investments that will protect your portfolio. And Nation, this all starts with what's called private credit, which at its core is simple. Private credit is just a loan to businesses, but not from a bank. Instead of going to JP Morgan or Bank of America for that business loan, companies are borrowing massive amounts from private investment firms like BlackRock, Blue Owl Capital, and Apollo. Part of this problem started with the 2008 financial crisis. Because of regulation around lending, companies could no longer get the money they needed from those lower interest traditional banks. You see that in loan data here. Even as that loan demand jumped after the financial crisis, loans as a percentage of bank assets cratered. Bank lending got stricter, more regulated, and honestly, a hell of a lot less interested in lending to small business. That left a huge gap and opened the door to private credit and what's called business development corporations. Now these BDCs and the big money investment firms like BlackRock filled that gap, making the loans that the banks wouldn't, but at higher interest rates. And it was a cash bonanza. For years after the pandemic, interest rates were near zero. Bank savings and money markets were paying no interest at all, so investors went hunting for those higher rates with the BDCs and the private credit funds offering 8 to 10, even 12% dividend yields. Here we see in this chart, even as the Fed funds rate and other rates dropped to near zero, BDCs were paying an average 9% dividend. It was only a matter of time before it became a bubble. And that bubble has become a $3 trillion time bomb buried in the economy. That's more than double the $1.3 trillion in subprime mortgages that triggered the 2008 financial crisis. And while the financial crisis was mostly tied to housing, this crisis is going to hit businesses and the economy directly. You see, that private credit, in the absence of traditional bank loans, is used for business growth, day-to-day operations, and most importantly, payroll. When that money disappears, and it's already starting to fade, it's going to mean job losses at a scale that we haven't seen in almost 20 years, in the worst possible time. And Nation, the alarm might be ringing right now, but those warning signs came late last year with a bankruptcy that caught Wall Street's attention. When two companies, First Brands and Tricolor, companies loaded with tens of billions of dollars in private credit debt, collapsed, Jamie Dimon, CEO of JP Morgan, the world's largest bank, said this.
And we think we're okay and other stuff, but my antenna goes up when things like that happen. And I probably shouldn't say this, but when you see one cockroach, there are probably more. And so everyone should be forewarned of this one.
I buried those cockroaches!
Cockroaches. That is exactly what we're seeing right now. Those early bankruptcies lit the fuse on a lot of loans that made during those easy money years to companies that were never that strong to begin with. Even insiders are warning about this one. One top Apollo exec recently criticized what he called the arrogance building in private markets during those years of that easy money. And one of the first major cracks showed up at Blue Owl Capital. This was one of those BDCs, those business development corporations, at one point offering investors double-digit dividends and grew to over $300 billion in private credit loans. Now, a lot of those loans started running into trouble, and here's the problem with investing in private credit and why it's starting to snowball right now. Because investors see those warning signs and they start selling. Well, those loans to businesses aren't something you can just cash out fast. Most of them are terms of 3 to 7 years. That means when investors stampede to the exits, withdrawing their money all at once, the lenders just can't call in enough loans, and it either collapses or just shuts off investor funds. That's what started to happen, and shares of these BDC and private equity companies are down 30 to 50% in just 6 months, and the journal reports funds across the industry are seeing rising redemption requests. Now, shutting off investor funds, that might save the lender, but it also starts a panic. And that's what we're seeing right now. Earlier this month, BlackRock, the largest asset manager in the world, limited withdrawals on a $26 billion private credit fund after investors rushed to pull that money out. Investors sent in over $1.2 billion in withdrawal requests. They got less than half that back. And now here's the part that most people don't see, why this is more important than you might think. Private credit isn't just some isolated corner of finance, it's deeply connected into the entire economy. First, just like those subprime mortgages in 2008, everyone is invested in these private credit loans. Banks, pension funds, insurance companies, they've all poured billions of dollars into these, chasing those higher rates. Bank lending to other financial institutions, part of them these private credit companies, has ballooned to $1.9 trillion from just $1.1 trillion 3 years ago. So when those loans go bust, that is systemic collapse. But then that's only half the problem. Small and medium-sized companies with under 100 employees make up more than half, 55.6% of all employment according to the Bureau of Labor Statistics. The economy is already slowing, with the last quarter's GDP less than half of what economists expected, and consumers are stretched thin on inflation. When that tap of money from private loans gets turned off, businesses cannot refinance their debt. And that means it's only a matter of time before layoffs. The job market is already at the worst it's been since the pandemic, with the US losing 92,000 jobs last month, its sixth month of job losses over the last 14 months. And this could become a spiral lower as layoffs crush consumer spending that kills the economy and brings more layoffs. And while I argued in our Sunday market update that AI wasn't yet to the point where it's replacing a lot of workers, this private credit implosion could be coming at the worst possible time. That's because the jobs we lose now, if that bubble pops, may never come back, because by the time the economy does recover in a year or two, AI is going to be at the point where businesses won't need those workers. Now, the best case here is that those private credit loans default gradually, that the layoffs are manageable. Now, that could give the Fed time to cut rates for stimulus to kick in and then save the economy and jobs. But that is not the most likely case, and even if it is, that same Apollo exec is saying this is going to be worse than people expect, and that the most likely scenario is a deep recession. Even if it's not though, if your job is one of those lost, it could still wreck your life. So I want to walk you through how to prepare, both with your finances and your investments. I'm going to explain what you can do to safeguard your money, and then the investments to make right now to protect your portfolio. First though, folks, this is extremely important and it affects everyone. So please help out by tapping that like button. That helps trigger YouTube to get the message out to more people so we can help as many as possible. So then how do you prepare for all this? Because this isn't just some abstract Wall Street problem. This is 2007, before the great financial crisis, and it's about to get real. The goal here isn't to panic though, it is to prepare. Now I'm going to lay out some steps, but I don't want you to think of this as like a forever change, minimalist living to the extreme. I am going to suggest that you pull back on spending and debt, but don't think that you have to be living off ramen noodles for the rest of your life. Think of this like a 3-month challenge, just 3 months to prepare your financial bomb shelter. And first is to get control of your debt, because just like those private credit loans are imploding the economy, your credit card and other high-rate debt will implode your life. Now the goal here isn't to pay off all your debt, and we're sure as hell not going to be doing that in 3 months anyway, but you can get out in front of it, and you do that in 2 ways. One, you're going to rank all your monthly debts from highest to lowest interest rates, and then make a little bit higher payments to the most expensive ones each month. And this usually means making those minimum payments plus as much extra as you can spare on those credit cards and personal loans. Your mortgage and your car loans are usually lower interest rates, so don't worry about them quite as much just yet. Paying down the high rate loans first is going to save you a lot more money. Second though, in these types of emergency preparedness plans, you're not putting every penny to pay down debt. That's where most people go wrong, because what good does it do to pay down your debt if you lose your job and end up in bankruptcy anyway? Folks, when the shit really hits the fan here, cash is survival, and you need to be building that up. Yes, make those extra payments on your high interest debt, but put at least a few $100s into savings each month until you can pay 2 or 3 months worth of expenses from it. Now I know most experts recommend having 6 months worth of expenses in those cash savings, but let's be real here, that isn't going to happen for a lot of people, and it keeps them from even getting started. So just focus on at least 3 months worth of expenses in that savings account. Paying down debt and saving, those will help, but even better is start cutting your expenses now before you're forced to cut even deeper. Yes, I know we all love our Netflix, and Spider-Man Brand New Day is out in theaters in July, but again, give me just 3 months of savings and skimping, and I promise you will not regret it. This means looking a little closer at those streaming subscriptions, the eating out at restaurants, that gym membership that you haven't used in 2 months anyway, and all those nights out. And nation, with the price of gas up 30% just in the last month, it is the perfect time to carpool or to take public transportation. But then while most people only focus on their debt and their spending side of the equation, the most important thing you can do is from that income side, both to make more money and become unfireable at your job. Making yourself an asset that cannot be lost at work comes from going a little beyond that 9 to 5. Start learning how to use AI tools like GPT or Claude to streamline and even improve your process. Folks, avoiding AI isn't going to keep it from taking your job. It's just going to make you less productive by comparison and easier to replace. And speaking of being productive, let's stop surfing the internet at work. Okay, not this channel because it's awesome, but if you want to be that person that your company cannot replace, then you need to be seen as a hard worker, someone that's going to carry the load when it's needed. Again, this isn't forever. Buckle down for the next 3 months, then it's back to watching cat videos all you want. And it's also time to start making friends, or at least stop being the office gossip. As much as we hate it, folks, being unfireable is as much about popularity as it is about being good at your job. That doesn't mean you have to become a kiss ass, but it does start with a smile. Stop complaining and stop criticizing your coworkers. But then, even the hardest working among us can still get axed if that whole company goes under. So, check out sites like Upwork or freelancer.com to see how you might make extra money. Just about any skill can be freelanced, and it only takes a few hours a week to help build that cash cushion. You're not looking to completely replace your income, you just need more options. Once that foundation is solid, now we can start talking about your investments, protecting your portfolio, and even growing it. This is right in my wheelhouse, not just for more than a decade as a professional analyst, but from 25 plus years investing my own money, living through some of the biggest market crashes in 2000, 2008, and 2020. And folks, you can pick all the stocks you want, but this is really about balancing your income risk with your investment risk. It's something nobody talks about, but it's one of the most important things you can do for your financial future. The idea here is that if you have a lot of income risk, maybe you work in a cyclical sector like hospitality, manufacturing, finance, or technology, maybe where the jobs are lost very quickly in a recession, maybe you don't have that union protection or seniority. If you have these higher risk income loss, then you need to take less risk in your financial investments, less financial risk. And what that means is just investing in the larger quality companies in safer sectors like consumer staples, healthcare, and utilities. Now we can use the sector tracker here to see what sectors held up as well as what stocks within those sectors. And we see here over the last month, energy has done really well. But of course, that's on Iran and the oil prices might not hold up in a recession. So we want to look here at other sectors that sell things you have to buy. Okay, utilities. Everybody needs electricity, even in a recession. Those telecom names in communication services. Nobody's canceling their cell phone because of a recession. You've also got healthcare. You're buying that healthcare whether there's a good economy or not. And then consumer staples. Both of these haven't done well over the last month. But in the case of a recession, in the case of a major market crisis, they will do exceptionally well. So we want to click through some of these and see. And remember, all of these are the 500 largest stocks in the market, in the U.S. market. So companies large enough to financial firepower to survive any kind of a recession. These are going to be the ones that hold up. They might not be the fastest growing stocks in the market, but they are going to hold up in a recession. They're going to protect your money, and some of them will even grow it. So here in utilities, we've got things like Constellation Energies, ticker CEG. We've got the Southern Company, very dependable company there, ticker SO. Got Duke Energy, ticker DUK. We can scroll up here, look at communication services. This one's done very well as well. Also in the last month over that kind of a recessionary environment or the fear environment, I'll say, we got Verizon Communications. We've got AT&T down here. We've got T-Mobile, ticker TMUS. Then there in healthcare, we've got the pharmaceuticals. We've got the medical equipment device makers. Got Moderna rallying after its multi-year losses there. Some of the ones I like a little bit better here, Johnson & Johnson, ticker J&J, just spun off a lot of its other businesses, now a more focused healthcare company. Very good one to look at. Amgen, one of the best drug makers you can buy, ticker AMGN there. Cardinal Health in the insurance business, as well as United Health Group, ticker UNH, hasn't done so well over the last couple of years, but is going to be stronger in a recession because people aren't canceling their health insurance just because a recession comes along. Now, another way to protect your stocks you already own is through buying put options or selling calls against them. Everyone loves Nvidia with its 50% return over the last year, but it hasn't been without its many crashes. And if the economy really blows up, you don't want to sell, but you still need that protection. You can do that by going to the options available, and we'll protect ourselves through mid August with these calls or puts. For example, selling this call option with a $180 strike price against the shares you already own gets you $24 in cash right now. That is a 13% downside protection on the stock. Or here, we can protect the downside while still keeping that upside potential completely. Buying this put option at $160 strike price costs just $10 each and protects you completely if the stock falls below that $160 in a crash. Now, there's a lot to work through with those strategies, and I know it's a lot of options jargon, so to help you get started, I'm extending the relaunch of our Ultimate Options course. Over 3 hours of video, I start with the basics, then walk you through all 29 option strategies, when to use them, and how to set it up, including a real-world example of shares of Tesla. The course also comes with a one-of-a-kind strategy finder to help you find the right option strategy, and an options calculator to show you exactly what to expect. And right now, I'm extending the relaunch offer of the course at a 38% discount. Save $150 off, but only for the next 3 days. You're going to get all the basics to get you started, the strategy finder to make sure you're using the best strategy, the options calculator to show you exactly how much you can make, walkthroughs on all 29 strategies, and a 14-day money-back guarantee. Now, that $150 launch discount is only available with the coupon code in the link I'll leave in the description below, so look for that link or just scan the QR code here. Nation, stocks and the economy won't crash all at once, but this bubble has been building for years, and if it's gonna burst, it's gonna do it in the next 6 months. That's still enough time to prepare to get your finances and your portfolio in order so you can not only protect your future, but take advantage of the opportunities when they come along. Get your $150 discount and everything you need to get started options investing with the special link in the description below. Get the strategy finder, the options calculator, and all 29 strategies, plus the 14-day money-back guarantee. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.